Gold's been on a really strong tear. People are buying it for a variety of reasons. Physical gold in particular has been very strong. But are we getting to the point now where the price is so high it's going to deter some more of that interest coming through? Are we going to be sort of capped out in terms of where we can go from here?
Well, good morning, and thanks for having me on. I think it's a really interesting time for gold, and I think that's a great question. And how we'd answer that would be simply to say, you've got to understand the global dynamic of where the demand's going to come from and how that's going to continue to impact the price. Over the first half of the year, what we've seen mostly has been Eastern investors, central banks pushing and driving the price. But as you've highlighted, the rate cut that's likely, the weakening of the dollar, the lowering of real rates, that's going to remove the headwinds that have kept the Western investor on the sidelines. So while we've seen that demand in the East, it looks like it could be slowing a bit, and the shift would be to the West. So to answer your question directly, we see a very good environment and a strong environment for the support of gold at these levels, and a likelihood that it'll continue to trend higher.
In terms of what is happening more broadly, the dollar is obviously coming down as part of that trend you've been talking about in terms of the rate narrative. Why are people buying gold right now? What do you think the main motivations are at the moment?
There's three factors that are keeping gold at the top of everyone's list, including central banks, which has been a big story for us for the last 2.5 to 3 years. It's actually a 14-year trend, but a 2.5, 3-year trend that's been very strong. So the first is that diversification benefit that you get from gold. I think the week of August 5th highlighted the fact that when you want the right kind of a diversifier in your portfolio, gold plays that role. So when risk assets are selling off, it holds its value as a store of value. Secondly, it adds that diversification in a way where the supply dynamic provides returns. And ultimately, it's a liquid instrument. And those three factors combined put it at the top of the list of a nice diversifying asset to a portfolio. If you think about where a reserve portfolio would look to add diversification against a weakening dollar or concerns around fiscal issues from the U.S. and the potential for issues around those assets, this type of asset that remains liquid and ready to be sold or obtained can actually add real diversification to your portfolio and strength to your portfolio. Risk-adjusted returns are favored by adding gold to a diversified portfolio.
Well, Joseph, expand on that story and the deficit story as well, because it's not just the states that is facing kind of that looming deadline when it comes to their fiscal budget in January. You're seeing it in France as soon as next month. You're seeing it, of course, in Germany as well. Some of the budget talks still a little bit icy there that we're trying to work through. How much demand does that create, though, for gold at a time when it's kind of largely expected that these are going to be looming issues? Is that really a catalyst that goes into the next 6-12 months?
So I think it's a great question. I think the way to approach this and to think about it is that it is a catalyst, but it's a slow-moving catalyst. What you're going to see as rate policies adjust and actually reset, and actually those factors weigh into the economy, you're going to see the Western investor move strategically to allocate to gold. We don't think it's going to be this shocking, quick movement on the gold price. We'll have volatility in gold, but what we won't have is rate cuts of 25 or 50 basis points in any of those markets, for example, have that much of a major impact on the gold price. It will be a strategic implementation that the Western investor will have as they diversify. So it ultimately is a global asset. I think you're highlighting Europe, which I think is a really interesting market. Over the last 6 months, what we've been seeing in terms of ETF flows there has been pretty substantial, over $3 billion of inflows into that market. So again, it's a quiet, slow movement of Western investors adding gold back into their portfolio.
Is it Western investors? I'm hearing a lot of Gulf asset managers buying. I'm hearing a lot of Gulf investors are buying as well. They are looking for a diversification trade. They're looking for a safety trade. What I'm not hearing, though, is the ETF trade. And it feels like that ETF trade has got a lot quieter. The expectation was that this would be the way that you traded gold. And if you wanted to buy that hedge in your portfolio, this would be the way that you do it. But a lot of people are turning to different and more physical sources. So why do you think that is?
Well, I think there's a few factors at play. Number one, the Western market has tended to like the ETF market, but remember, it's only 6% of the total investment market for gold. I think the level of comfort and confidence, and particularly in the Eastern investor to own physical gold, is actually a pretty well-known and a pretty common wait for them to express their investment interests. I think you'll see the ETF flows come online. And again, over the last 3 months, what we've been seeing is a quiet, slow shift away from nothing but redemptions, not only in North America, but in Europe, and starting to see the flows back into the market. The ETF market in Asia has seen about a $3.5 billion inflow. But again, it's 6% of the market. The OTC market is the majority of where investment takes place. And large bars, kilo bars, bars and coins, those are common instruments that get used regularly. And I think that people have a confidence level of owning gold that way. And it's simple that they could make that investment happen.